Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
We've got a great one today.
We really do. Today, we are breaking down one of the most interesting companies on the market, the financial fortress that is S&P Global.
A true giant.
Absolutely. On the surface, this is the ultimate sleep-well-at-night stock. It's a dominant player, a household name, and, feels like it's been around since the dawn of capitalism itself.
It practically has.
But the critical question for us as long-term investors is this. Is the valuation justified by its status as the toll road of global capital? Or is the Anthropic risk, the rise of generative AI, about to crack the moat that has stood for a century?
That is the whole ball game right there.
That is what we are here to find out.
It really is. That's the central debate. It's the collision between a 100-year-old legacy and, the newest, most disruptive technologies on Earth. Before we dive deep into that battle, though, a quick heads up for the audience.
Right. If you're looking to invest, we use interactive brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time. It really helps us out.
And while you're there, please like, subscribe, and let us know your questions in the comments. We do read them all.
Now let's get into it. Pillar number 1, the business model.
Okay, let's unpack this machine. When people hear S&P Global, they usually just think of the S&P 500 index.
Yeah, the ticker on the bottom of the screen.
Exactly, the ticker tape on the news. And sure, that's the flashy hood ornament. But when you really pop the hood, this company isn't just a participant in the market. It is the infrastructure.
It's the plumbing.
It's the plumbing. I like to call it the toll road of global capital. If you want to move money from point A to point B in the institutional world, you are very likely paying a toll to S&P Global.
That's absolutely the right analogy. It's not just a service provider, it's a gatekeeper. And to really understand the valuation, we have to look at the 3 distinct engines driving this thing.
Right.
Because they all have very different economics and different physics, so to speak.
Exactly. Let's start with the oldest and maybe the most controversial engine, ratings. This is a credit rating business, Standard & Poor's, Moody's, Fitch. It's the classic oligopoly. But let's move beyond the buzzwords. Describe the actual mechanics here. Why do we call this a tax on capital?
Well, it functions as a tax because it's transaction-based, and for all intents and purposes, it's unavoidable.
Right.
Imagine you are the CFO of a massive corporation, let's say Apple, and you want to raise, $10 billion in bonds to buy back stock or build a new factory.
Great.
You cannot just go to the market and say, trust me, I'm good for it.
Even if you are Apple, with hundreds of billions in the bank.
Even if you are Apple. The pension funds, the insurance companies, the sovereign wealth funds, their charters often legally restrict them from buying debt that hasn't been rated by a nationally recognized statistical rating organization or an NRSRO.
That's the key, the regulatory moat.
It is. So Apple has to get a rating. They have no choice in the matter.
So they call up S&P. What's the bill?
The fee structure is just fascinating. Issuers pay roughly 7 to 10 basis points of the total issuance volume.
Okay, so a basis point is 1/100%.
Exactly. So if you issue $1 billion in bonds, you're handing S&P a check for close to $1 million. It scales with the size of the debt.
And the beauty of that, from a business perspective, is the pricing power. We talk about pricing power a lot on this show. But this is the definition of price inelastic.
Completely.
If S&P raises that fee by 10% or even 20%, the CFO isn't going to say, you know what, never mind, we won't get rated.
They can't, because the cost of not being rated is catastrophic. This is what we call the uncertainty penalty.
I explain that.
If you don't get that S&P stamp of approval, the interest rate investors' demand to lend you money just skyrockets. You might have to pay 6% interest instead of 4%.
Okay.
On $1 billion, that extra 2% is $20 million a year, every year. So paying S&P a one-time fee of $1 million to save $20 million a year is the easiest math equation a CFO will ever do in their life.
So they basically have to pay the toll. There's no other road to take.
They have to. And we've seen this play out even in 2024 and 2025 when issuance volumes were a bit lower because of higher interest rates. S&P still maintained revenue growth.
How?
Just by raising prices.
Yeah.
They knew the market had absolutely no choice. It's incredible leverage.
It's incredible leverage. But, okay, let's pivot to the second engine, which I think is actually the crown jewel of the whole company.
I would agree.
The indices.
Yeah.
S&P Dow Jones Indices. This is where the S&P 500 trademark lives.
This is what we call a royalty on wealth. And it's maybe the best business model I've ever seen.
It's unbelievable.
Think about the massive decades-long shift toward passive investing. You have these giants like Vanguard and BlackRock running ETFs that track the S&P 500. They control trillions of dollars.
Trillions.
But here's the kicker. To legally call their fund an S&P 500 ETF, or to even use that index data to balance their fund, they have to pay S&P Global a licensing fee.
And that fee is based on assets under management, or AUM, right? It's not some flat fee.
Correct. It's a percentage. It's usually around 2 to 3 basis points on the AUM. Now, 3 basis points sounds tiny. That's 0.03%.
It's nothing.
But when you apply that tiny percentage to $10 trillion or more tracking the index, the numbers just get staggering.
They become enormous.
And the best part, the most beautiful part of this business model, it has zero marginal cost.
That's the key takeaway here. Zero. Marginal cost.
Exactly. If the stock market goes up 20% in a year, S&P's revenue from the Indices division goes up 20% automatically.
And what do they have to do for that extra revenue?
Nothing. They don't need to hire a single new employee. They don't need to buy a new server. They don't need to do any extra work. It is pure, unadulterated operating leverage.
It's the ultimate inflation hedge. If asset prices inflate, their revenue inflates right alongside it. It's a royalty on the entire capitalist system.
It really is.
And then you have the third engine, market intelligence. This is Capital IQ, Platts, the data terminals.
Right. This is the subscription model. High recurring revenue, renewal rates over 90%.
Sticky.
Very sticky. This is where they sell data, analytics, and, very importantly, commodity pricing benchmarks through Platts.
Explain Platts. This is a part of the business people don't really know about.
So if you are trading oil or shipping wheat or buying aluminum, the price isn't just what we agree on. The price is often defined as the Platts benchmark plus or minus $2.
So they own the ruler.
They own the ruler that measures the market. It's an incredibly powerful position to be in.
So, okay, we have a tax on debt, a royalty on wealth, and a subscription to critical data. That brings us to the Synaptic framework, the Moat. Why is this fortress so hard to breach? We talk about network effects a lot, but let's be specific. How does that apply here?
It's most visible in the indices business. It's a perfect example. Liquidity begets liquidity.
Right.
Why does everyone track the S&P 500? Because everyone else tracks the S&P 500. It's the global standard, the default benchmark for performance.
It's reflexive.
It is. If you're a derivatives trader, you want to trade the contract with the most volume, which is the S&P. That volume attracts more traders, which creates more volume. It's a self-reinforcing loop.
So I can't just launch the Synaptic Investing Awesome 500 index tomorrow and expect Vanguard to switch over.
Even if your index is technically better constructed,
It doesn't matter.
it doesn't matter. The switching costs are basically infinite because the liquidity isn't there. And then on the rating side, it's all about trust.
Or, as you put it in the notes, uncertainty reduction. I think that's a great way to phrase it.
Yeah, that's what they're really selling. S&P has a 100-year stock of trust built up. When a pension fund buys a bond, they aren't just buying the yield. They are buying the assurance that an independent third party has vetted it.
You can't replicate that overnight.
You can't. Even if a startup uses some fancy AI to rate bonds better, faster, and cheaper, the pension fund manager isn't going to buy it.
Because of career risk.
Exactly. The career risk defense. It's maybe the most powerful mode of all. If the bond blows up and they used S&P, the manager can say, hey, I did my job. It was AAA rated by Standard & Poor's.
They keep their job.
They keep their job. But if they use a startup and it blows up, they get fired for negligence. It's that simple.
It's the classic, nobody ever got fired for buying IBM, just applied to credit ratings.
Precisely. And when you combine the regulatory license, the fact the government literally designates them as an NRSRO with that brand trust and the embedded switching costs as all the bank risk models, you get what we call a Lollapalooza effect.
Lollapalooza, that's a Charlie Munger term. Break that down for the listeners who haven't, memorized poor Charlie's Almanac.
Munger used it to describe a situation where multiple biases or competitive advantages all converge and act in the same direction. It's not additive, it's multiplicative, it's not 1 + 1 = 2, it's 1 + 1 + 1 = 10.
So you have the government license, the brand habit, the network effect, the career risks.
All acting together to make the moat incredibly wide and deep.
However, we have to look for the cracks. We call this the anti-moat check. We aren't here to just praise the company.
Right.
One thing that stood out in the sources was the cultural friction. S&P merged with IHS Markit a few years ago. That was a massive deal. How is that integration actually going?
It's been a heavy lift. I mean, you're mashing together two very different cultures.
How so?
You have the legacy S&P side, very prestigious, very banker-like, kind of slow-moving, established.
Right.
Then you have the IHS Markit side, scrappy, data-driven sales teams,
Wow.
moving fast, breaking things. A very different vibe.
Okay.
And if you look at Glassdoor reviews, you listen to insider chatter,
Yeah.
there is real friction there. It's the classic old guard versus new blood conflict.
Does that worry you regarding long-term execution? Usually, culture clash kills mergers.
It's a risk, certainly. It's something to watch. But, interestingly, retention in the core ratings analyst group remains high.
Yeah, is that?
The prestige of working for S&P still holds a lot of weight. So while the sales teams might be clashing, the intellectual capital, the people actually analyzing the debt, seems to be staying put for now.
So it hasn't affected the quality of the product?
Not yet. But it's a yellow flag, not a red one.
Okay, so the business is a fortress, even with some, let's say, internal squabbling.
Mm-hmm.
Let's move to pillar number 2, financial resilience and capital allocation. Because a great business can be a terrible investment if they just burn all the cash. But S&P seems to be, well, printing money.
Printing money is barely an exaggeration. Let's just look at the quality of earnings. Operating margins are hovering around 42% to 45%.
Yes, insane.
That is elite tier. There are software companies, SaaS darlings, that dream of 40% margins.
And what's interesting is that the margin trajectory is actually expanding.
It is. As the business shifts more toward data and indices, which are higher margin than the more labor-intensive ratings business, the overall profile of the company just gets more and more profitable.
And we have to talk about stock-based compensation, or SBC.
Yes, the silent killer.
In the tech world, we constantly see companies with great adjusted margins, but when you look at the real cash flow, they are diluting shareholders to death to pay their employees. How does S&P stack up?
It's a breath of fresh air compared to pure SaaS companies. SBC is there, sure, but it's moderate, around 4% to 6% of operating cash flow.
Just so manageable.
It's not predatory. But the real story here, the thing that gets us excited, is the cannibal trait.
I love this term, the cannibal. Explain what that means for our listeners.
A cannibal is a company that aggressively eats its own shares. They aren't just buying back stock to offset the dilution from employee options. They are genuinely, consistently shrinking the total number of shares outstanding.
And S&P is doing this.
Oh, yeah. S&P Global is shrinking its net share count by about 2% year over year, like clockwork.
Which means even if the company's profit stays exactly flat zero growth, my earnings per share still goes up 2%, just because my slice of the pizza is getting bigger.
Exactly. It creates a floor on the earnings growth. They are consistently returning over 75% of their free cash flow to shareholders through buybacks and dividends.
It's a machine.
It's a machine designed to return capital.
Now, I noticed something a little weird in the numbers when I was prepping for this. The reported return on invested capital, the ROIC, looks just okay.
Yeah.
It's like 10–11%. For a business with this kind of moat, shouldn't it be higher? Usually, wide moats show 20–30% ROIC.
This is a classic accounting distortion, and it's so important not to be fooled by the headline number.
Okay, explain.
The reported ROIC is dragged down by one thing: goodwill. When they bought IHS Markit, they added about $60 billion of goodwill to the balance sheet.
Pause there. Define goodwill in this context. What is that?
Goodwill is essentially the premium you pay over the book value of the assets you're buying. S&P paid a huge price for IHS Markit because of its future earnings potential, its brand, its data.
Right.
Accounting rules say you have to put that premium on the balance sheet as an intangible asset called goodwill. And that $60 billion bloats the invested capital denominator in the ROIC equation, making the return look artificially small.
Right, because goodwill isn't a real physical asset you have to maintain. You don't have to spend money to paint it or repair it like a factory.
Exactly. It's an accounting fiction. If you look at the tangible return on capital ignoring the goodwill and just looking at the actual capital required to run the business, it is astronomical.
Yeah, high.
We're talking over 40%. This is an asset-light business. They don't need to build factories or buy inventory. It requires very little capital to grow, which leaves these huge piles of cash for the buybacks we love.
Speaking of that IHS Markit deal, that was a bet the company move. Was it worth it?
The jury is still deliberating, but the early signs are pretty positive, especially regarding the data integration.
But they had to give some things up, right?
They did. They had to sell off some valuable assets like OPIS, the Oil Price Information Service, to satisfy regulators. And that was painful. OPIS was a great asset.
So a tough pill to swallow.
It was. But strategically, the merger positioned them to dominate the private markets, which, leads us perfectly into the next pillar.
Right. Pillar number 3, the Anthropic risk and future growth. This is the meat of the debate.
It is. This is where the bull and the bear go to war.
Let's start with the bull case. Where is the growth coming from? We know public debt is pretty saturated. Everyone who needs a rating basically has one. So what's next?
The next frontier is private markets. Public markets are huge, but private credit and private equity have just exploded in the last decade. Historically, this whole world has been opaque. The data is messy. It's hard to get. Through that IHS market acquisition, S&P is positioning itself to be the source of truth for private credit, just like it is for public bonds.
Bringing transparency to an opaque market.
Exactly. That's a huge growth vector.
And there's the ESG angle, too. I know ESG is a political hot potato right now, but if you just remove the politics from a pure revenue perspective, companies need the data, right?
Correct. We call it anthropogenic risk modeling, climate risk, transition risk. Whether you agree with the politics or not is irrelevant to the investment thesis.
The demand is there.
The demand is there. Insurance companies, asset managers, they need to model these risks. They need to know if a factory is in a flood zone or what carbon transition costs will be. They pay S&P for the data to do it. It's a growing, high-margin revenue stream, regardless of the political headwinds.
Okay, so a clear path to growth. But now we have to bring in the challenger, the red team.
All right, let's do it.
The argument, the bear case, is you are buying a legacy data aggregator right before the cost of data goes to zero. This is the AI threat.
This is the Anthropic risk. And the thesis is simple. Generative AI, like Claude or GPT, effectively commoditizes data aggregation and, to some extent, analysis.
Right.
If I can ask an AI to scrape the web, read every financial filing, analyze a company's balance sheet, and give me a credit risk score for free or for $20 a month, why would I pay S&P $50,000 for a terminal?
That's the scary question, the disintermediation thesis. Could the big asset managers, your BlackRocks, your Vanguards, just build their own internal AI credit agents?
It's a valid fear. I mean, imagine BlackRock trains a model on 50 years of global credit data. That model might be able to predict defaults just as well, or maybe even better, than S&P's team of human analysts.
And if that happens?
If BlackRock can build an AI that outperforms an S&P human analyst at near zero marginal cost, they might stop paying for the external ratings. Or, at the very least, the pricing power completely collapses. Why pay 10 basis points if your internal AI does it for free?
That's a serious threat to the whole model.
It is.
But there's a counter-argument to this, which I find really compelling, the bloat thesis.
Right. The bloat thesis argues the exact opposite.
Explain it.
The idea is that in a world flooded by AI-generated content hallucinations, deepfakes, synthetic noise, just pure garbage, the value of verified truth goes up, not down.
That makes a lot of sense. If the internet becomes 90% AI slop, I need a gold checkmark, a trusted source, more than I ever have before.
Exactly. S&P becomes the oracle. They become the validation layer for the AI's output. You might use AI to do the grunt work, to sift through the data, but you still need that final S&P stamp of approval to trust the output.
And to cover yourself from that career risk we talked about.
Precisely. Plus, there is a legal and proprietary defense here that I think the bears are missing.
What's that?
LLMs cannot legally scrape private company cap tables or proprietary credit data that S&P owns. That data is behind a wall. AI can summarize the public internet, but it can't summarize what it can't see.
So the moat might actually be the proprietary nature of the raw data, not just the analysis of it.
Correct. S&P owns the raw material. You can't build a house without bricks, no matter how good your robot builder is.
Okay, fascinating debate. Let's look at the numbers again. Pillar number 4, valuation and the verdict. We are recording this for the episode dated February 4, 2026. The stock is trading around $468 a share.
Which puts the valuation at a 34.1x trailing 12-month PE ratio, and the free cash flow yield is about 3.9%.
34 times earnings. That is
Yes.
not cheap. That is a growth stock multiple on a 100-year-old financial services firm.
It's undeniably rich. The market is pricing in expectations of roughly 9% to 11% earnings growth for the next decade.
That's the hurdle.
That's the hurdle. If they hit that, the stock is probably fairly valued. If they miss it, look out below.
You did a fair value triangulation in the notes. Walk us through that. What are the different ways to look at this?
Sure. So if we look at historical mean reversion, S&P usually trades around a 28x earnings multiple, not 34x.
Okay.
If we apply that more normal 28x multiple to expected 2026 earnings of roughly $18 a share, we get a fair value of around $504.
Okay, so at $468, it's a little bit below that. That sounds okay.
A little bit, but that's a fairly optimistic way to look at it. If we use a more conservative owner earnings model, a discounted cash flow model, we get a value range of somewhere between $440 and $480.
So we are right in the middle of that range, smack dab in the middle.
Exactly. We are in no man's land. It's not screamingly cheap, and it's not irrationally expensive.
So what does that mean for an investor today?
It means the strict buy zone for us would be between $425 and $450. Right now, you're paying a fair price for a great company, but you aren't getting a bargain. There's no margin of safety.
Right. So let's project this out. We're long-term investors. What does the 10-year shareholder horizon look like? From 2026 to 2036.
We use the Cannibal math to project total shareholder return, or TSR. We have 4 components. First, organic revenue growth.
Okay.
We expect that to be around 7-9%, driven by the debt issuance cycle coming back and that steady, relentless passive flow into indices.
Okay. 7-9% from the business growing. Then margin expansion.
Management targets expanding margins by 50 to 75 basis points a year. Let's be conservative and call that another 0.5% to 1% boost to earnings growth.
Okay, that makes sense. Then the buybacks.
Now, this is where the high valuation really hurts you. We call this the diet cannibal effect.
The diet cannibal, I like that.
Because the stock price is so high, at 34 times earnings, the buybacks are just less effective. You're buying fewer shares for every dollar you spend.
Right, your dollar doesn't go as far.
Exactly. And if the stock was at 15x earnings, the buybacks would be hugely accretive. At 34x, they're kind of weak. So instead of a massive 3 or 4% boost, the buyback yield is probably closer to 1.5%.
And the dividend adds slightly under 1%.
Right. So if you add all that up revenue, margins, buybacks, dividends, you get a gross return of about 10% to 12%. And that sounds great.
It does. But I sense there's a catch.
There is. The killer variable, multiple compression.
The PE ratio coming down from these lofty levels.
Exactly. If the PE compresses from the current 34x down to a more historical and frankly more reasonable average of 22x over the next 10 years, that acts as a gravity well on your returns.
How much does it hurt?
It drags your annual return down by about 3% every single year.
So your 12% potential return becomes 9%.
Or 7%. The net result is an expected TSR of roughly 7% to 9%. Which, is likely to match the S&P 500, maybe slightly lag it, unless their growth accelerates significantly above the targets.
So you're taking on single stock risk for market level return.
Yes, that's the crux of it.
And there is a darker scenario. You called it the Cisco 2000 effect in the note.
This is the warning. This is the real risk. Cisco in the year 2000 was a phenomenal business. It literally ran the internet. The moat was incredible. But the stock price was priced for absolute perfection.
And when growth slowed just a little bit,
the multiple collapsed.
So what's the analogy here? If AI-driven deflation causes S&P's growth to fade to simply GDP levels, say 4% or 5%, what happens?
Then the market will not pay 34x earnings for a GDP grower. They might only pay 15x. And if that happens, your 10-year return is effectively 0.
Wow.
You hold the stock for a decade and make no money, even though the company remains profitable and dominant. That is the risk of buying a great company at too high a price.
That is the inversion. Great business, bad price.
Precisely.
So let's wrap this all up with a final synthesis. How do we score this?
On quality, it is Tier 1. Absolute elite. The combination of a tax on capital and a royalty on wealth is incredibly rare. There are maybe 5 companies in the world with this kind of business quality.
But on valuation?
Valuation score is fair to expensive. It reflects the quality, but it leaves absolutely no margin of safety for the investor.
So the verdict is, it's a watch list stock.
Yeah.
If we get a market correction, a dip into that $425 range, you back up the truck. But right now, you're paying full retail.
That's the discipline take. It's a binary outcome this decade. Will it be the victim of AI commoditization, or will it become the ultimate and even more valuable source of truth?
Which brings us to the final provocative thought. We think about S&P Global as a finance company. We obsess over credit ratings and debt issuance. But ask yourself this. In 2036, If the S&P 500 trademark becomes the single most profitable piece of intellectual property in the world, surpassing Mickey Mouse, surpassing Pokemon, surpassing Star Wars, does it even matter what the credit ratings business does?
That's a fascinating way to frame it.
If the entire world's wealth is indexed to that one brand, are we just looking at the world's most expensive yet most inevitable royalty check? Are we buying a finance company, or are we buying the ultimate brand of capitalism itself?
It's a question worth pondering.
Thanks for watching. We'll see you in the next deep dive.